Welcome to part 2 of the IPSAS Introduction in Conceptual Framework. In this part, we are going to focus on the conceptual framework, which establishes the concepts that are to be applied in developing IPSAS and RPGs that are applicable to the preparation and presentation of general purpose financial reports for public sector entities. The conceptual framework itself is structured in the following manner. There is the role and authority of the CF, objectives and users of GPFRs, qualitative characteristics, reporting entity, elements in financial statements, recognition in financial statements, measurement of assets and liabilities, and presentation of general purpose financial reports. Now you find that a lot of these are similar to what we would have under IFRS, but the ones for the IPSAS are mainly tailor-made for the public sector. Role and authority of the conceptual framework. The role of the framework is to establish the concepts that underpin financial reporting by PSEs that adopt accrual basis of accounting. It neither establishes authoritative requirements nor overrides the requirements of IPSAS or RPGs. It therefore applies to general purpose financial reports of governments and local governments, government ministries, departments, programs, commissions, agencies, and also international governmental organizations. The UN, for instance, has already applied IPSAS fully. Objective and users. The objective of financial reporting by PSEs is to provide information about the entity that is useful to users of GPFRs for accountability and decision-making purposes. The identification of accountability as an objective of financial reporting reflects the fact that most governments and public sector entities operate for service delivery rather than profit seeking, and that their nature of funding is mainly through non-exchange revenue. As a result, you find that primary users of financial statements are mainly the service recipients, the people who are serviced by the PSEs, and also the resource providers who are responsible for providing finance to those particular entities. The qualitative characteristics are the attributes that make the information to users and support the achievement of the objectives of financial reporting. They apply to all financial and non-financial information reported in general purpose financial reports, including historical and prospective information and explanatory information. The qualitative characteristics under IPSAS are the following. Relevance. The information should be capable of making a difference in achieving the objectives of financial reporting. Faithful representation. It should represent the economic phenomena it purports to represent, which means it should be complete, neutral, and free from error. Understandability. It should enable users to comprehend its meaning. And for this, there is an inherent assumption that users have a basic understanding of accounting and also have a willingness to study the information diligently. Timeliness. The information should be available for users before it loses capacity to be useful for accountability and decision-making purposes. Comparability. It enables users to identify similarities in and differences between two sets of phenomena. And verifiability. It can be corroborated. The reporting entity. This is identified as government or other public sector organization, program, or identifiable area of activity that prepares general purpose financial reports. It may comprise two or more entities, and a separate legal entity is not essential for an entity to be classified as a reporting entity. The IPSAS board identifies key characteristics of a reporting entity as one that raises resources from or on behalf of service recipients and uses resources for the benefit of constituents. And also there are service recipients or resource providers that are dependent on general purpose financial reports. The elements of financial statements are assets, expenses, liabilities, ownership contributions, revenue, and ownership distributions. We will look at each of these in detail. An asset is a resource presently controlled by the entity as a result of past events. And a resource is an item with service potential or the ability to generate economic benefits. Service potential is a concept peculiar only to IPSAS, not to IFRS. Past event would be a resource that an entity presently controls and must have arisen from a past transaction or other past event. A liability is a present obligation of the entity for an outflow of resources that results from a past event. A present obligation is a legally binding or non-legally binding obligation, such as a constructive obligation, which is brought about by a company's practice and not necessarily legal matters, and which an entity has little or no realistic alternative to avoid. Revenue and expenses. Revenue would be the increases in the net financial position of the entity other than arising from ownership contributions, and contrary to that, expenses would be decreases in the net financial position of the entity other than decreases arising from ownership distributions. Ownership contributions are inflows of resources to an entity contributed by external parties in their capacity as owners, which establish or increase an interest in the net financial position of the entity. And ownership distributions are outflows of resources from the entity distributed to external parties in their capacity as owners, which return or reduce an interest in the net financial position of that entity. In terms of recognition, for an element to be recognized in the financial statements, the item should meet the definition of an element, and the item should be measurable in a way that meets the qualitative characteristics. The measurement objective. We'll look at the measurement basis for an asset and for liabilities. For assets, we have two broad categories: historical cost values and current cost values. Under current cost values, we have different surrogates that can be used to determine the current cost value, these being replacement value, market value, net selling price, and value in use. For liabilities, we also have the historical cost or current cost values. And under current cost values, those surrogates would be cost of fulfillment, market value, cost of release, or the assumption price. For presentation, this chapter provides guidance by evaluating presentation of three related dimensions. Selection. What information is required in the financial statements and general purpose financial reports? It should be concise and easy to understand. Location. This addresses allocation of information between different reports and on locating information within a report. And organization. It addresses the arrangement, grouping, and ordering of information. It includes decisions on how information is arranged within the general purpose financial reports and its overall structure. Finally, who should apply IPSAS? The IPSAS are designed to apply to public sector entities that meet all the following criteria. It is responsible for the delivery of services to benefit the public and or to redistribute income and wealth. It mainly finances their activities directly or indirectly by means of taxes and or transfers from other levels of government, social contributions, debt, or fees, and does not have a primary objective to make profits. Therefore, if an entity does not meet all of these criteria, it should report using IFRS and not IPSAS. Should you have any questions, please do not hesitate to direct them to training and advisory services. Thank you for your time.